Well, greetings, everybody. Today I've got on my channel, I'm very happy to have an old friend of mine, Alasdair Macleod, and we've known each other for some time since I was in office. And I know a lot of you follow him and follow me together, so a lot of the stuff you might already know through following him. But if you haven't, I suggest that you do, and all the links are here. You'll find them following Alasdair Macleod. I think, without embarrassing him, I think he's probably the lead guru on matters of banking and gold and such. And I like to trail in his wake a little bit and pick up on stuff. I like to think of myself as something of a gifted amateur, but I think Alasdair Macleod is generally acknowledged to be the master player in this field. So I've got a few questions for him, and I've got a few things so he can expand on it. There won't be much of me this morning, thank goodness. It'll be mainly he. So we'll kick off. Got a few questions so I don't lose track of it. Now I'm getting old. I'm going to ask, and I've done this myself on a few occasions, but I think it needs bringing up to speed, and that is, I was talking in my book, Magic of Banking, about a little bit about bail-ins and bailouts and such. And Alasdair was very kind enough to write a chapter or two in my book about such matters and other matters. So for everybody, could you just revise for us all, please, Alasdair, on bail-ins, bailouts, and just tell us where we are and where you think we might go in the future with this kind of what was supposed to be an escape route, but I know that both of us don't actually see it quite so simply. So far away, dear boy, far away.
Okay, well, when it comes to bailing out banks or bailing them in, it is a fundamental duty of a central bank and its regulator, if the regulator is separate, to ensure that the banking system does not fail. And we saw in what they call the Great Financial Crisis, though I think there's a greater one coming, so I think it'll probably be renamed, perhaps the minor financial crisis of 2008-9, that even relatively small banks were bailed out because there was a heightened risk, if you like, of contagion between failing banks. You know, a small bank failing, it was there was a big concern in official circles that this could actually escalate. So I think one's working assumption is that the central bank will always bail out or arrange for the acquisition, if you like, of a failing bank. And it doesn't matter what it is. So that is our working assumption. Now, this is really commonly referred to as a bailout. It's not necessarily a bailout. I mean, we saw, for example, with Silicon Valley Bank, which was a regional bank in the States, which failed last year, that it was arranged for a larger bank, I think it was JP Morgan, to take them over. So there wasn't a bailout as such. It was just acquired, if you like. And that was enough to stabilize the situation. But bailouts basically are, when the central bank uses its own balance sheet to bolster a failing banking institution. Now, when we had that great financial crisis, there was a chap called Gordon Brown, he of the brown bottom, who put his name to this new structure, which would relieve taxpayers, according to him, of the burden of rescuing banks from the malfeasance of their directors, and which is the way he looked at it. Therefore, the answer was that instead of voters, instead of the electorate having to bear the cost, taxpayers having to bear the cost, it would be borne by the bank's bondholders and shareholders. When it came to large deposits, of course, large deposits are always held by evil people who, have somehow stolen money or whatever. This is in socialism eyes, and I guess in Gordon Brown's eyes, may or may not be true. But sort of, if you're looking at 150,000, 200,000, £1 million deposits, then they would be cannibalized into recapitalizing a failing bank. So that was the idea of a bail-in. Now, I would say that if a central bank decided to use this mechanism as part of a rescue operation, then it would merely spread the crisis. Because just imagine if you're a depositor and suddenly you sort of think, my God, my 2 million quid at whatever bank is suddenly at risk. What are you going to do? You're going to take it out. You're going to create the run. So instead of seeing, as we saw with Northern Rock, queues of people around the block trying to take their money out, it would simply be a run, if you like, by depositors, by big depositors, just transferring their funds from one bank into another. So it was the most stupid thing. I think that, this always happens, Godfrey, when you get the political class trying to interfere in banking matters, which they don't understand. They're pursuing a completely different agenda of trying to satisfy an electoral whim or whatever it might be. The whole thing is just a complete awful mess. So I think we can assume that in a future financial crisis, banking crisis, we will continue to see bailouts rather than bail-ins. I think that's a very, very important point. I would also reassure deposit holders that the idea that a central bank will walk away from that primary responsibility of ensuring the integrity of their bank and therefore losing their deposit, that's not going to happen. I think that's a very, very important point to understand. However, this does bring about other problems, and that is you've got to look at what the real cost, the hidden cost of these bailouts are likely to be. Well, there are two aspects of this. The first is the destruction of a central bank's balance sheet. And this is very apposite at the moment because particularly with rising bond yields, with the fact that central banks have been buying in their own government bonds at very low yields. I mean, they've almost pushed the yields down so they can pay top dollar, top pound, top euro for government debt. Now, of course, since interest rates started rising, they're all horribly underwater, no more so than the Bank of Japan. I did a calculation a little while ago, and I think the yield on the 10-year, which is the big holding that the Bank of Japan has, the 10-year JGB, that's the Japanese government bond, is about the same as it was when I did the calculation. I think I came up with something like the equity, which was I think it was 100 billion yen or 100,000 billion yen. I mean, we're talking about so many zeros, you lose the plot trying to understand it. But I reckoned that that was underwater by about 40,000 times. In other words, now you and I know that if we were directors of a company and the company, the debts of the company exceeded its assets and wiped out the equity, we'd be it would be a criminal offence to trade while insolvent. But this doesn't apply to central banks. All the central banks, all the major central banks are in this problem. So at the moment, we don't worry about it. It is actually quite easy to recapitalize a central bank. I mean, there's no problem doing that at all. I won't go into details, but it's so simple. It's just book entries. I mean, that's all it is. But there is one central bank where a banking crisis, a global banking crisis, I think will not be able to recapitalize itself, and that's the ECB. Now, the reason for this is that its shareholders aren't governments, which it can turn around to and say, right, we're just going to rebook, we're going to book you a loan on the asset side of our balance sheet. And on the other side, instead of making it a deposit, we will make it equity, and that recapitalizes us. Voila, that's how you recapitalize a central bank. It's very, very simple. You cannot do that with the ECB. The ECB has the problem that its shareholders are the other national central banks. The other national central banks are equally, in many cases, in negative equity position. So they would need to recapitalize themselves in order to recapitalize the ECB. Now, I can just imagine, and you would have more experience of this, having been in the European Parliament and on finance committees in Europe and so on. But I can just imagine the debate on the floor of the German Parliament. Sorry, excuse me. I'm getting over a cold.
Oh, poor man.
Imagine, I can just imagine the debate for the enabling legislation, whereby some damn stupid politician stands up and says, well, hold on a minute. The Bundesbank is asking us to recapitalize itself and at the same time to recapitalize the ECB. But aren't you owed through the Target 2 system €1 trillion? Oh my God. You can see this getting into the long grass, and it's not going to happen. This is not just Germany. It's all the other national central banks are going to go through the same debate. Some of them, presumably, I don't know what the democratic arrangements are in all member states in the Eurozone, but I think it's a pretty good bet that you're going to require parliamentary approval in a lot of them. And it's just going to make it impossible for the ECB to deal with this. Now, the ECB can, print euros, as they say, ad infinitum. That's not a problem, but the problem is its credibility. I can just see that the credibility of the euro would collapse under those circumstances. And this is really where the buck stops, when it comes to bailing in, bailing out, whatever. The problem is that the central banks will be doing it from a position of insolvency themselves. The whole system is basically bust.
When I was on the Monetary and Economic Affairs Committee in the European Parliament and various other subcommittees of it, I made these points because obviously I was a fixed interest investment manager for a big pension house in the city for many years. So I knew how the things worked, and I tried to explain this to the committee. And it was quite clear. I basically said everything you said, to them. And I'm going back to, this would be 2012, perhaps, whatever, over 10 years ago.
Yeah.
Now, here's the frightening thing. And of course, with every committee as such, you have your representative of the Commission there, not just the people on the Committee of the Economic and Monetary Affairs, Parliamentary Affairs. I can assure anybody watching this, and I can assure you, as I looked round the committee, a committee of such is normally consists of 40 people, almost nobody understood what I was talking about. Almost nobody understood what I was talking about, because the committee consisted of Bulgarian socialists, Danish housewives, whatever it was. It was a very eclectic mix of people, but almost if they had been selected to not know anything. And even when I retired from that, somebody was kind enough to say there was only one person who really understood anything that we talked about for all those years, and that was Godfrey Bloom, because he's actually been in it. There were one or two people who had worked at a relatively, what you and I would regard as a relatively junior level at Deutsche Bank or something like that, but middle ranking people. And given that the senior people in those banks don't understand it either, it's really. And we have a governor of the Bank of England now who's regulating box tickets. Doesn't understand a thing. Doesn't understand a thing. So. Nobody really understands it. It's a little bit, if you go back, and I know you like your history too, as was it? I think it was Palmerston who was talking about the Schleswig-Holstein question. That there's only 3 people understood it. One was a professor who went mad thinking about it, and there was somebody else, I think, who was dead, and he said, "And me," and I've forgotten it. So nobody understands these things unless they sort of, excuse the phrase, Alasdair, geeks like us. We're sort of geeky people, aren't we, really, when it comes to this kind of thing? We do understand it.
Yeah.
Now, the problem that we have here is one of timing, which both of us know from your equities background. We know that we know something's going to happen. We know that, and I know that, and you know that, because this is what we do for a living, basically. Of course, what we don't know is why we're not on a bloody great yacht in the Med, is because we don't quite know when it's going to happen. And if we knew when it was going to happen, we'd be very seriously rich men. But we don't. We just know it's going to happen. And I've been wrong because I thought it was all going to collapse a lot earlier than this. Where are we? 2024. I guess 2020. I thought it was all gone by then, collapsed, but it's not. But it will.
Yeah.
Are you prepared to stick your neck out on any of this and give us a when?
Well, all I'll say is that it's getting closer. But I think actually that recent events show that it is accelerating. I mean, there are so many problems, as you rightly point out. But to my mind, the really big problem is the debt trap which the US government is now in. And this is now becoming urgent. And the reason it's particularly becoming urgent is because the US opinion polls are increasingly in favor of Trump. Now, the importance of that is that Trump is a spendthrift. His policies are to increase tariffs. He's got absolutely no understanding of the consequences of the Smoot-Hawley Act back in 1930. Let's put that to one side. I mean, that created the enormous disaster of the 1930s, not only for America, but for agricultural industries around the world. I mean, my grandparents were farming in Kenya at the time. So, you know, I actually know about this, if you like, from childhood. But the other problem, of course, is that, of course, inflation is going to increase, as a measure of the debasement of the dollar, because the consumers will have higher prices. Not only that, but his spending policies will increase the budget deficit at a time when it's becoming impossible to fund. And that is highly inflationary in the sense of debasing the currency. Now, the reason that the gold price is rising so strongly, I mean, you'd think it's ahead of the Kazan thing, but last Friday, Putin said, no, we're not going to put it on the agenda. It's premature to start thinking about a trade settlement currency. So the markets knew on Friday that wasn't going to go ahead. And since then, gold has continued to rise. Why? To my mind, the answer is quite simple, and that is that the word on, if you like, the institutional street, the central banking street, whatever, throughout Asia, throughout BRICS, is the dollar is going to collapse. And therefore, everybody in Asia, and I'm talking about really from central banks, wealth funds, oligarchs, and all the rest of it, are stampeding into gold out of dollars. The main point to realize is they're selling dollars. So how long will it take? Well, at some stage, US interest rates are going to have to rise to counter this. And as they rise, of course, we know what happens to bad debts in a highly leveraged banking system. The banking system in America, just for the record, is leveraged assets to equity around about 13 to 14 times. That's not excessive compared with elsewhere. In Japan, it's 20. In the Eurozone, it's 20. In the UK, sort of quite like the US, but there's quite a wide variation, if you like, with different banking institutions. So banks are uncomfortable with their current position. And this is why they're not really lending too much into the private sector. That instead, of course, government demand for funding has meant that virtually all the bank's liquidity has gone from out along the yield curve into T-bills. I mean, that is the safest thing you could possibly have as far as a bank accounting in dollars is concerned. They're all going into T-bills. And this is why the money funds They were given the facility to, a reverse repo facility with the Fed. In other words, what they could do is they could deposit their dollars with the Fed, and that becomes a reverse repo. That's gone down over the last 2 years from around about $2 trillion to about 250 billion. I mean, the amount has absolutely collapsed. The US government is basically absorbing all the liquidity within the system. And the banks don't want to really commit themselves to small and medium-sized businesses, which are the backbone of any economy throughout the US. And we have the same situation in this country. But of course, the statistics say that everything's tickety-boo and wonderful and all the rest of it. But these statistics are all made up. I mean, you and I know that. And I think hopefully, some of the people who view this will also already know this. But it's worth reminding everybody just how bad these statistics are. I mean, I go back to Lord Canning, 1820s, 26, I think he was Prime Minister, and who said, I can prove anything with statistics except the truth. And that was before we had computers and all the rest of it, and all the jiggery-pokery, which statisticians and statistical departments run by governments get up to. So, I mean, just concentrate on the things we can see. We can see that the banking system is over-leveraged. We were talking about banks earlier. We can see how central banks are deeply into negative equity. We can see, therefore, that the only way in which a banking crisis can be dealt with is by excessive quantities of currency credit being issued, one way or the other, invested in whatever is required to keep something going. On top of that, you've got zombie companies everywhere who got so used to the idea that we could go out and borrow at 2% or whatever the rate was. And now they're having to refinance at 5%. I mean, look at Thames Water. I mean, that's an absolute classic. The whole of the private sector industry, which relies on buying a utility type operation and leveraging it up with debt. You've got certain earnings and all the rest of it, but, nobody seemed to think, well, what happens when we've got to refinance this? Oh, we won't worry about that. But of course, this is where Thames Water and various other water companies, I think, which have been acquired or leveraged themselves up, that's where the trouble is. But getting back to governments, I mean, government's debt to GDP, in the case of the US, is about 135%. And they've got to refinance this. And, as an old gilt man, you'll know that when the debt profile gets really short, this just gets more and more dangerous.
Yeah.
And this is actually happening in the States. I mean, I was looking at the US Treasury figures a couple of months ago, and they reckoned that the average maturity was something like 65 months. They're not funding much out along the yield curve because the only demand for notes and long-term bonds are really from insurance and pension funds. Foreigners aren't buying it. And we can see that China is selling. I mean, China is selling dollars. Now, this is part of a de-dollarization policy. But when you see the central bank going out and buying gold, I know that the PBOC has not admitted that it's been buying gold recently. But, people get this so wrong. They think the PBOC is buying gold. No, they're selling dollars. That's the key thing. It's the dollar that is going down. And I think that's really where the principal crisis is. And as interest rates rise, which they will have to do in order to reflect, if you like, foreigners' opinion of where the dollar is going to be, let us say in a year's time, look at annualized interest rates, they won't buy, in theory, they won't buy dollars until they get the rate to compensate them for their expected loss of purchasing power by holding onto that dollar. Plus, they will also need a return on it. Otherwise, no deal. That is the reality of the situation of a fiat currency when it starts collapsing.
I But it brings me on to the next one. By the way, as a complete aside here, one geek to another geek. If you ever find a decent biography of Canning, let me know. I've been seeking for a decent one for years. So give me the heads up if you find one. But that brings us to the next question, a couple of questions really, and that is, if you want, we live in a world where everybody wants to do something the easy way out, the stroke of the pen. Nobody wants any pain, which of course just brings us fully circled to the revaluation of gold. The revaluation of gold. And I'd like your view on that, because if you look at if you look at the figures and you look at some of the punts that you get on this, how you revalue and of course the central banks in of the South, or what do you want to call it, the BRICS and so on and so forth.
Global South, yeah.
Yeah. Are presumably, with the rate that they're accumulating gold, are assuming it would be very much in their interest to see a revaluation of gold, which would, I think, have to be fairly drastic. And the only people against that at the moment, of course, are the Fed. But I don't see how the Fed can hold out against that globally, because it's their off-ramp, if you will. But that means gold going to some extraordinary figure, way, way, way above what it is today. Because it's in their books, I think, or it's still in their books at the Fed at $35 or something, isn't it?
No, 42.22.
Oh, well, smart.
It's still the official rate.
Yeah, okay, 40. Anyway, but you get the drift of that. I'd just like your view on that. If you feel that is feasible, not feasible, and if so, when? I believe personally that it has to happen sooner or later, because I can't see another escape route. What's your view?
Well, I think it's a huge mistake to think in terms of, we've got to devalue the currency against gold in order to set a rate which we can fix. And therefore, in theory, we will be looking at the relationship between the quantity of dollars in circulation and the amount of gold we have, divide one by the other, and you get a figure of whatever you dream. That's not actually how it works. The other thing is, look at it from the foreigner's point of view. They're not actually saying, we think that the right rate for the dollar gold exchange rate is a figure. No, what they're saying is, we just want to get the hell out of the dollar. Now, you could fix the dollar. In theory, you could fix the dollar at the current rate. But what you'd need to do is you would need to raise interest rates to attract gold into the US Treasury. You'd need to be absolutely clear and clean about what you have got, which of course they can't do. And then you would have to use interest rates to not manage the economy, but to manage the relationship between gold and the dollar, which at that stage would become a gold substitute. In other words, you would be quite happy to accept dollars on the basis that it's convertible into gold, so that the value of gold in terms of commodities, goods and services, whatever, is actually what fixes the value of the dollar. At the moment, there is nothing fixing the value of the dollar, and that is the real problem. So I think the concept, I mean, I've seen so many people, it's a very common thing to sort of, try and take the current quantity of currency and sort of, look at gold reserves and say, well, they're going to require, however much, or it's going to require gold to rise to a certain level, whatever. No. The destruction of the dollar in terms of its purchasing power is the underlying problem. And that is going to continue. And the reason it's going to continue is because the political imperative makes it impossible to deal with the question of the value of the dollar. I mean, we had, you remember 1976 when we went to the IMF. I mean, the full story was, first of all, we were bailed out by the Americans, who then, because they rushed in and bought sterling because it was threatening to break 1-to-1. They rushed in and bought sterling in late 75. And of course, the deal that was done behind closed doors was that the IMF are going to come in and they're going to lend you the money so we get ours back. That was basically what happened. But But that was very good because it took the political imperative out of the equation. It meant that the IMF basically was running the government. And Healy was sort of sitting there, he couldn't do anything. I mean, instead of, this lingo about squeezing the rich until the pips squeak. You remember that one?
Oh God, yes, I do. Yeah, and so does my father, my late father.
I'm sure. Anyway, all that was dropped, and they had to balance the budget. This was the key thing, and then the thing came under control. But I mean, the cost, and this is opposite to today's situation. The cost. I mean, you remember Treasury 15s, 15 and a quarter, and the 15 and a halves of 98. I can't remember the maturities on the others, but these were medium dated. Excuse me. These were medium dated gilts. Imagine what that coupon would do to the US Treasury. I mean, it's just, and we've got, in those days, in 75, 76, we were going through the sort of periodic inflation crisis. We've still got an inflation crisis here. I mean, the idea that inflation is sort of getting back to 2% is completely immaterial. Apart from anything else, you can't measure the general level of prices. It's just a theoretical construct which we can talk about in abstract terms. You can't measure it. The fact of the matter is that what we're looking at is a collapse in the confidence of fiat currencies. And recently, when I've been, on speaking engagements, after I've sort of warmed up the audience a bit, I ask them, and how's your faith in your government when it comes to valuing your currency? Get out of credit. Get out of credit, I tell them. And that basically is what the foreigners are doing. And the foreigners always see it first. It's, it's the users of the credit who see it last. I mean, this was the experience in Germany in 1922 to 23. It's going to be exactly the same this time. And so the way to look at the relationship between gold and currency is that, yes, eventually it will be fixed because fiat currencies always fail. Now, I don't think it's going to be a simple process because the politicians will try and do it their way rather than, a sensible way. And that will fail. I mean, they're trying to get around this already with the idea of CBDCs. I mean, what a load of hogwash. I mean, it really is complete nonsense. It allows the government to direct capital investment. I mean, come on, this is a joke. So, really, the way to look at it is not, this is where we might be able to fix the gold currency relationship. No, it's completely immaterial. The point is that currencies are still collapsing, and that's being reflected in a rising value for gold because gold, I mean, you look at Diocletian's edict, 305 AD, and you look at the prices of things. Now, they closed down the slave markets, so you can't compare those. But other things like, sort of army coats and shoes and food and so on and so forth, the prices are not too dissimilar. If you look at the value of gold measured in oil, I mean, well, we know what's happened with the dollar. I mean, it's been incredibly volatile. And not only that, but from 1950, when the price of oil was something like $2.53 a barrel, we're now, 70 or something, has been 140. But with gold, it's just, the value of oil in gold has just gone tick, 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 tick. Almost a straight line. I mean, the most it's been is 2.5 times. The worst it's been is about 50%. That relative to fiat currencies. And I would say that a lot of the volatility in gold is because of government attempts to try and manage the gold price.
That graphic on gold priced barrelage of oil always stuns such undergraduates as I speak to these days. I have to say they stare at it and it's very difficult to believe, but because it tells a story. One glimpse of that graph shows all you need to know.
Yeah.
But there's another interesting phenomenon here, is there? One might argue that the IMF. Back in the 70s, the mid 70s, when we had the embarrassment of the gnomes of Zurich telling us what to do, that wonderful phrase. The thing had changed a little bit now. The IMF then was, if you like the old prudent provincial bank manager with the small business or the local, the local doctor or whoever was the client.
Yeah.
We don't have that. Would I be right in thinking we don't have that dynamic anymore? Because the IMF, like the UN and all the other things there, are all part of this. The IMF aren't going to come into anybody now, I would imagine, and say, you're spending too much money, Mr. UK government, and you've got to balance your books. I can't imagine the IMF telling anybody with the directorship lineup of the IMF, telling anybody to balance their books, because nobody, it's modern monetary theory, it doesn't matter, debt doesn't matter, so you just grind on and on until it does matter. So you have this fascinating phenomenon that chaps of round about our age, just everything that we think about money. We've got these young chaps coming up thinking, it doesn't matter. Well, it bloody well does matter, and we're going to find out the hard way, it seems to me.
Well, I think that's right. I think that the difference, the IMF has always been under the US government's thumb. I mean, basically, it's an extension of the US government, which is why it was worth me just reminding viewers that, the first step was America came in, bought sterling to try and stop it falling. And the quid pro quo was they sent in another arm of the government, i.e. the IMF, whose task, incidentally, was just limited to managing the dollar debt of US government with emerging economies. I mean, suddenly this was actually outside their remit. They're all part of the whole big control system. Now, of course, it's become somewhat more political, as we saw with the European debt crisis, particularly the Greek debt crisis, when you had the ECB working alongside the IMF, basically stiffing in the Greek government and economy into doing what they wanted. It's always a very difficult thing, I think, the whole of this IMF thing, because it has become politicized. I mean, apart from anything else, my fundamental position is that none of these institutions should exist. They really should.
I totally agree there. Yeah, absolutely.
So government should withdraw completely from any attempt to manage the economies. They should withdraw from spending, from being any more than, say, 10 to 15% of the economy. I mean, there's no way this is realistic at the moment. But after a crisis, it will be eventually what has to happen. And funnily enough, the most interesting economy, which actually could go on a gold standard tomorrow, is Russia's. And if you look at income tax, for example, 13%, 15% if you're a high earner. The government debt to GDP, 21%, and this is in spite of fighting a war against us in the Ukraine. They do have the benefit that they've got enormous natural resources to export to pay for all this. But the moment they go onto a gold standard, you then have the situation, and this is the way you manage things. Going back to what I was saying about the way the U.S. Treasury would have to do it. You have at the moment, I think the deposit rate at the Russian central bank is 18%. Now, if let us say they go onto a gold standard, now the rate doesn't matter, and that's a fundamental point. The rate doesn't matter. It could fix it today. Then the Russian banks and Russian institutions and those who are close to it, like some of the Chinese, for example, would see that they have a gold substitute yielding 18%. So what do? Well, they go into Western markets, buy it where the lease rate's 2%, transport it over to the Russian central bank, and they get paid in rubles, gold substitute, yielding 18%. What's not to like? What an arbitrage. I mean, fantastic. And this is why interest rates are really, their function is to manage the gold reserves, not manage the economy. So, and this was a lesson that we learned the hard way under our gold standard in the 19th century, and it was only really after, well after the 1844 Charter Act, where the bank, that had to be suspended 3 times. But after that, lessons were learned that this is the way you got to do it, and so we've still got. We've still got that information. We just deploy it today. It's easy to do.
That brings me on to my final question, and I thank you for your time, Alasdair. It's always fascinating talking to you. But there's the final thing, which we know that the BRICS are toying with, thinking about, a common currency, and it's in debate and so on and so forth. Now, I have a little bit. You probably got to help me on this. What I don't understand is that given the accumulation of gold by BRICS and continuing BRICS countries and BRICS applicants, so on and so forth, including African countries, some African countries, why would we not go back maybe 300 years and call trade into BRICS trade in gold without the gold necessarily having to move, but being properly audited, which even the Fed doesn't do. Well, we don't know it doesn't do, but it doesn't seem to do. So then you can then issue a paper, which could be a bill of exchange or something like it, rather than a piece of currency. Bill of exchange. So, for example, if Iran is selling oil to Africa for coconuts or whatever, you get that. You get it. Now, if it's open audit situation, which I'm not sure the Chinese would be particularly comfortable with, but on having said that, they say the Chinese can say this is our gold. You can audit it. You can't audit that bit over there, but you can audit this bit, and then you could make your book transfers. And if it became totally imbalanced, for example, you could then ask for the gold in specie to be transferred, and knowing it was there and within the audit trail, which is really how paper money started. The promise to pay the bearer on demand. Now, what I'm not understanding is that could be done surely relatively soon and relatively easily without trying to find, which I would regard as totally impossible, a common currency per se. What's your view?
Well, you're absolutely right. I would just clarify one point, and that is that a proper working gold standard means that gold is hardly ever used in settlement of transactions. This is always the gold substitute. So the new BRICS currency would act as, basically it's bank credit, if you like, issued on the back of the stability given to it by adequate gold reserves. That's the key thing. So there's no problem in doing that. The trouble is that you need to get unanimous agreement within BRICS in order to bring in such a currency. And India doesn't want to do it. India has been taught Keynesian economics by us, so it's our fault. But
yes, I know. Fair dues.
They're stuck in the failing macroeconomic whatever. So there's that. Different governments have different problems. If you were, let us say, an African country, you don't want to kick the dollar in the teeth. Because otherwise the Americans come in and before you know where you are, you as president suddenly find that you're assassinated and someone else is now running the country more friendly to the Americans or whatever, or the IMF comes in and puts the screws on your debt. So there are all sorts of reasons that BRICS cannot agree on this. India does have the problem that not only does it trade with Asian countries, but also a lot of its trade is with the sort of NATO alliance, if you like, and China, of course. It has a large export element to its economy, and it's going to have to move away from that. But the idea of destroying that deliberately by going on to a gold standard is unattractive, as one may imagine. So really, what I would say is that the problem is less economic. I mean, the short-term economic problems, but then, you're going to have to evolve from point A to point B. The real problem is political. That's why it's not going ahead. And this is why Putin said last Friday that the introduction of such a currency is premature. But you're also seeing, the mood music coming out of the few commentators who appear to be sort of relatively close to to the issue, if you like. I mean, there's just so much confusion. They're talking about, sort of a new CBDC or whatever, and they're talking about bringing in blockchain. They don't understand credit, for God's sake. I mean, they just got no idea whatsoever. The level of commentary on this is actually appalling. So, but I think the key to it, I mean, I don't see that necessarily they would introduce a new gold-backed currency properly. I mean, if I was one of the, if I was Russia, what I would do is I would put the ruble on a gold standard. Because, and this is another aspect, the moment you get one major currency, now, okay, you could probably say the ruble isn't a major currency, but when you get one major currency going onto a gold standard, it's going to undermine the whole of the castle, the mountain of fiat currencies, starting with the dollar. And so from Russia's point of view, the easiest way to win the war is basically to take away America's financing, just collapse its currency. And what I would do, I mean, it would be very attractive to Mr. Putin, I would think, to say, okay, BRICS can't decide on this currency issue. I tell you what, we'll put the ruble on a gold standard. If you want to use it, by all means, your choice. And but at the moment, it's a sort of it's in a sort of stasis, because if you look at it from China's point of view, she's importing stuff, she's exporting stuff, and she can manage things so there's a reasonable balance, if you like. Or if there isn't a balance on the trade, then she would do it in such a way that an African nation would end up with yuan, rather than China ending up with kwacha or whatever the currency is. So that's easy. Russia has more of a problem because Russia doesn't really import an awful lot. It's got all the resources it needs. It imports some stuff from China, of course, technology and things like that. But basically, rather like the South African economy, when we isolated it, due to apartheid back in the 60s and 70s, Russia actually is pretty well independent of the rest of us. And so, she really could run her economy quite happily on a gold standard without... I'm sorry about this cough.
Not at all. Yeoman work.
But she could actually run her economy quite happily on a gold standard. She has a problem if she doesn't do that, insofar as she's going to be getting Indian rupees, she's going to be getting kwacha or Kenya shillings or Ugandan shillings or Egyptian pounds or whatever, all this rubbish, and also, of course, Iranian rial. I mean, all this rubbish, which actually is only good for lighting fires. So it's Russia that's got the problem on this one. And so I think at some stage she's going to break ranks. But coming back to the BRICS currency, it ain't going to happen. It really is not going to happen. And because it's just too contentious. The whole situation is political. And this is why what we're seeing is, instead of politicians sitting around and forming a committee and coming up with solutions and all the rest of it, what's happening basically is that people are voting with their feet. I mean, you have the central banks throughout Asia. You have the wealth funds throughout Asia. You have the oligarchs throughout Asia. They're looking at this dollar and they're seeing exactly what's happening. They see the debt trap that the dollar's in. They now see that Trump is likely to be the next president, and they think, shit, we don't want dollars. Just get out. And they know that where the dollar goes, pounds, euros, yen,
Mm,
and all the rest of
mm.
it go. So there is absolutely no um, safety, if you like, in getting out of the dollar, getting into another fiat currency.
No, 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 no,
We're
no.
talking about the whole of the fiat currency system because the king rat of dollars, if you remember
Yes, I do.
the film about Changi, I can't remember what it was
Yeah,
called now. The king rat of dollars,
yeah,
the
yeah,
king rat of currencies is, of course, the dollar. And
yeah,
dollar goes, that's where the rest go. Forget
yeah,
money supply and all that sort of
yeah,
stuff.
yeah.
It's completely immaterial.
Bloody marvelous. Anyway, I've taken enough of your time and I'm very conscious of it. And I do hope you'll come back on the channel in a few months' time that we can chew the fat again, because I always find it absolutely fascinating.
Well, I'd
Uh,
love to because it's so enjoying talking to you as well.
and so we can. You did promise me lunch too in London
I do, yeah,
at
but
your
you
club.
just you just said off camera that you so rarely go down to London now. It's not worth going down
It
there.
is quite rare, but mind you, of course, you're tucked nicely away in the West Country as well, aren't you? You
I
don't go
am.
up to London much either, do you? No,
No,
but I will. I tell you what, I will get you is I'm coming through Somerset to spend a few weeks in Cornwall in February, I think it is, and
oh
so
right,
we might peel off. And
yeah, I'd love to see you. Love to see you.
don't think closing the curtains and turning the lights out and remaining quiet. We'll bang on the door till you open it.
Well, I look forward to it. I really do. So that would be
Marvelous.
great. But we might see you in London. I mean,
Yeah,
you might come to my club and try their beef Wellington, which is very
uh,
good.
I shall look forward to it. Yes.
Yeah.
Thank you so much. Thank
All
you
right.
again.
Take care.
Thank
Bye.
you. Toodaloo. As most of you know, my work is very heavily independently research based, and I get my information from all over the world. It would help if you press the subscribe button and the little bell next to it, because the more subscribers I have, the more likely it is that international independent research institutes will share their material with me. It's most helpful, and then of course I automatically share it with you. So, surprise, won't cost you anything. Thank you very much.